The first day of April is popularly called as April Fool's Day, and it is customary to play practical jokes and pranks on people. Now, this fooling of people need not be restricted to just one day in April. In fact, it's something that happens every minute in the stock markets. And in this video, we shall examine some of the most foolish things that investors do. It's a topic that comes very naturally to me, as I too have my own list of blunders, mistakes and incredible acts of foolishness to share. और हाँ, अगर आप इस वीडियो में बताए जाने वाले बेवकूफ़ियों को हिंदी में समझना प्रेफर करते हैं तो सीसी बटन दबा के हिंदी सबटाइटल्स को ज़रूर ऑन करें. लेट्स बिगिन. To call an IPO a fool's endeavor can be a bit controversial. So in the interest of clarity, while we agree that some IPO deals have been good for retail investors, it still does not hide the fact that most investors are played for a fool. Let me explain this. In our understanding, there are three fools in an IPO process. The first one is the IPO subscriber who's investing his money when the game is completely stacked against him. And that's because of many reasons. For one, the amount of information made available to the retail investor is often on the lower side, and it is always the promoters, venture capitalists and senior employees who have all the updated and relevant information. Further, since it is these company insiders who are also the ones who are offloading their shares to the public, we can always expect them to showcase only the good stuff while leaving the complications hidden in their 500-page red herring prospectus. Another major giveaway is the entire timing of the IPO, which, as history reveals, is always done during a bull run, has a lot of advertising and PR support, and is almost always preceded by many rounds of private investment at lower than IPO prices. Now, in spite of these warning signs, the problem is that our fool number one is not bothered. He's not bothered because he thinks there is a greater fool who is always available, who will then buy the shares from him at an even higher price. So the thought process is, I will receive shares from the IPO at 300 rupees, and by the end of the week or end of the month, the share price will go up to 500 rupees and I would have sold these at a cool profit of 66%. So while there is a lot of hope here, there is also a lot of assumptions. The first assumption is that the share price will go up, which may or may not happen. The second assumption is that there will always be a greater fool who will want to buy the shares at a much higher price, which is 500 in this case. Again, this may happen, but it may also not happen in the short time span of a few days or a few weeks that you're trying to take advantage of. And the third assumption, and probably the big flaw in this approach, is to think that the promoters who are offloading some of their shares at 300 rupees are the greatest fools to have sold their equity at 300 when they could have got 500 rupees per share. So that's the three fool theory of IPOs. The first one being the ignorant subscriber, the second one being the Santa Claus who presumably buys shares at 50, 60, 70% of the IPO subscription price, and finally the promoter who hypothetically undervalues his equity. It is quite a lot of smoke to inhale, but hopefully one thing we can all agree upon is that no IPO is ever launched keeping the interest of the retail investor in mind. A common investor behavior is to believe that a steep fall in the price of a stock automatically turns it into a bargain. And the most frequent method used by discount hunters is to pull up the 52-week low list from time to time. In all honesty, even I used to employ this method under the assumption that if a stock price is at its 52-week low, then there's a fairly high chance that the stock price would increase sooner or later. It was much later when the realization came that there were two problems with this theory. One, it was truly possible that the stock price was overvalued even at a 52-week low. You know, it's like one of those shops in Karol Bagh who tripled the price of a shirt only to offer it at a 50% discount. The second problem with this approach was that a rise or fall in the price of a share is only incidental to the changes in the underlying business. Like in this case, the fall in the price of a stock might have happened due to a number of factors, such as changes in the earning power, regulation, some kind of market disruption, or it could also be due to some internal factors like an incompetent management, labor unrest, shortage of machinery, etc. Another extreme form of this behavior is where investors put their money in really beaten down stocks, assuming that at some point these stocks will jump up and they will jump up really big. Some examples of such beaten down stocks would include Yes Bank, Reliance Capital, Suzlon Energy, etc., all of which have fallen by over 90% from their all-time highs. But over time, our learning here has been to assume that the price has reached its lowest point based on a hunch is being totally foolhardy and is certainly a recipe for financial disaster. A large number of investors sell their stocks or mutual fund units when their prices have gone up a lot. This is absolutely okay as long as your calculations show that there is a case for acute overvaluation and that the present prices are not justified. Unfortunately, that's not what most people do. Instead, most investors generally fix a mental price target. So they would say something like, I will sell some of my units or sell some shares if it reaches X price. After many years of doing this, we now realize this as one of the most ludicrous things to do. And that's because when we buy stocks, we buy them with the hope that it would keep on going up forever. And by selling them based on some mental target is basically ensuring that one will never make even 100% profit from this investment, let alone a 100x return on investment. Nevertheless, millions of people around the world use this counterproductive approach to investing. And the real solution for this, and probably the best way to build wealth, is to buy exceptionally well-managed companies at reasonable prices and then holding on to the shares as long as the value exceeds the price. Simply said, as an investor, it is important to understand the difference between the price of a business and the value of a business. It's pretty normal to find that some of our investments don't deliver as per our expectations. The reasons could be anything, and it's important for investors to understand the causes that are shaping this mismatch between performance and expectations. But an undesirable behavior that is often seen, and I too have been guilty of it, is that most investors hold on to these broken down investments in the hope that eventually their prices will rise and then they would be able to square off their position. Now, the problem with this is maybe the price rises, but it's also possible that the price might go down. In fact, it can become zero. One can never be sure, and in a lot of cases, simply to avoid accounting losses, investors willingly suffer huge economic losses. So to escape this fool's paradise, a better approach would be to first investigate the reasons for the notional loss, and then if no conclusion can be placed, it would be in your interest to replace the loser investment with a better proposition which will offer you a higher probability of making money. Net, there is a lot of data that shows that it is absolutely foolish to hold on to losers in a hope that things will be better tomorrow. There is a beautiful quote by Warren Buffett who says, "The stock market is a device for transferring money from the impatient to the patient investor." It is not uncommon to see investors doing good research and buying some excellent stocks, but they often get tired of waiting for the stock price to rise. So they get impatient, they sell their stocks, and like clockwork, the price starts to increase after they have sold their holdings. The mistake most investors make here is that they focus on the price and not the value. And since we are doing a quote fest, here's one that I read on a bumper sticker once. "A fool knows the price of everything and the value of nothing." The point simply is, if the investor has chosen the right company for the right reasons, eventually the price and the value of the company will match. This matching process might happen in a month or in a few years, but in most cases, as long as the price of the investment is lower than the value it offers, you have a big incentive and reason to be patient and to hold on to your investments. In other words, to sell simply because the price has not risen, even though the intrinsic value of the shares has been rising, is utterly foolish. Stock prices fluctuate all the time. It is this volatility that opens up many opportunities for making money in the stock market. And yet, many investors get spooked with big jumps in the stock markets and end up selling some or a lot of their stocks and mutual funds if the market goes up by 4 or 5% over a week. Over time, this trading mentality to investments without a strategy is certified detrimental to investors in the long and even in the short run. In fact, this foolish practice of selling in the name of profit booking is one big reason why people don't make as much money in the stock markets as they possibly can. And this surely isn't investing. All humans make mistakes, and all humans have beliefs, some of which can be tagged as outright foolish. What can really help towards one's success in investing is to learn new perspectives and not justifying the bad decisions that one might have taken along the way. We presented here 6 foolish mistakes which often have the biggest impact on one's stock market fortunes, at least in a negative sense. So to round up this video, let's look at 3 simple things an investor can do in terms of making some really good wealth building decisions. 1. If you don't understand it, don't do it. This is especially true for people who are moving into stocks without an understanding of how stocks are valued, the economics of an industry, when to buy, when to sell, etc. Our advice to these investors will be to stick to mutual funds and use the professional services of a fund manager and his team who will do all the necessary research and invest your money with optimum care. Point 2, don't time the market. Believe me, I have watched and read dozens of interviews of people who have made millions and billions in the equity markets, and not a single investor has attributed his or her success to their market timing skills. 100% of them have always bought stocks in solid businesses at reasonable valuations and have held their investment for long periods of time. And the last point, point 3, is disciplined investing always works. Now imagine I take your money and give it to an undisciplined, disorganized money manager. Would you like that? Of course not. Similarly, for you to build a big wealth corpus, you need to start accumulating shares or mutual fund units using a regimented investing strategy like an SIP. This will allow your money to accumulate bit by bit without causing any hassles to your lifestyle. It always works and it will definitely work for you. And with this, we come to the end of this video. I hope you liked our April Fool's Day presentation and will use this information to improve your own investing practices, strategies, and roadmap. Don't forget to share your learnings and mistakes in the comments box of this video. And if you are liking the ET Money YouTube channel, do spread the word by sharing this video with your friends and colleagues over Facebook and WhatsApp. Thank you for your time, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.